Welcome in. It's really great to have you here with us for another deep dive today.
Yeah, really glad you could join us.
So whether you are actively managing a portfolio,
Right.
or maybe you're just monitoring the rapidly shifting landscape of artificial intelligence, or even if you're just simply looking to understand the mechanics behind how the world's most influential companies structure their power, you are definitely in the right place.
Absolutely.
Our focus today, it centers on a very brief, but honestly incredibly dense piece of source material. We are going to be analyzing an excerpt from a piece titled The OpenAI Legal Arsenal and the Road to IPO.
Right, and specifically, we're looking at a transcribed conversation between two industry observers, Marcus and Sarah,
Yeah.
and they're just completely dissecting a series of strategic moves by OpenAI. And, the brevity of this text is actually what makes it such a valuable exercise.
It really is. I mean, we're talking about a localized conversation here, just a quick back and forth between two people.
Exactly. Yet embedded right there within their dialogue are these massive, massive indicators regarding corporate governance, financial posturing, and really the intense competitive pressures that are defining the current AI market.
Oh, totally.
It's a prime example of how surface-level news, so in this case, simply the hiring of a law firm.
Right, which sounds boring on paper.
Exactly.
Right,
but it often masks a much, much deeper strategic maneuvering.
Right, so to our listener, if you hold tech stocks or if you just care at all about the future of tech, this brief little snippet we're looking at today contains some massive hidden signals. We are going to unpack Marcus and Sarah's analysis of OpenAI's recent legal retainers, some staggering revenue rumors that are circulating right now, and the underlying competitive paranoia that seems to be really accelerating their timeline for a potential IPO.
It's a lot to cover from such a short exchange.
It is. Okay, let's unpack this. The excerpt begins with Marcus highlighting a major development. He basically tells Sarah to just stop scrolling entirely, noting that if she holds tech stocks, she desperately needs to pay attention, because OpenAI just hired what he calls, and I quote, the Avengers of the legal world.
Which is, it's a striking way to frame a corporate hire, right?
It really is. The Avengers.
But to truly understand the text, we have to look really closely at Sarah's initial reaction. She serves as the voice of standard market observation in this conversation.
Yeah, she's very skeptical at first.
Highly skeptical. She points out that companies hire lawyers all the time. She calls it, exactly what companies do.
Which is fair.
It is fair. And from a baseline operational standpoint, her logic is totally sound. Any entity moving toward a liquidity event of this magnitude is going to assemble a massive legal team. I mean, it is a strict regulatory necessity.
Right. But the conversation hinges on Marcus correcting that assumption. He clarifies that they didn't just, bulk up their legal department with random suits. They made two very specific, highly deliberate hires.
Two very distinct signals.
Exactly. So the first firm he mentions is Cooley. And he immediately categorizes Cooley as, well, he says it's fine, standard tech stuff.
Which it is.
Yeah. And for you listening, this really establishes the baseline. If you are operating the upper echelons of Silicon Valley, Cooley is just a known quantity. They handle the mechanics.
Right, the plumbing.
The plumbing, perfectly said.
Okay.
They file the necessary S-1 documents with the SEC, they ensure regulatory compliance, and they just manage the vast amounts of boilerplate paperwork required to transition from a private entity to a public one.
Yeah, Cooley represents the traditional playbook. Like, if a company is simply looking to navigate the bureaucratic hurdles of going public, that level of representation is more than sufficient.
Standard operating procedure.
Exactly. But then Marcus introduces the second retainer, and this is where the strategic signal becomes glaringly obvious. He names Wachtell, Lipton, Rosen, and Katz.
And the moment Marcus drops that name, Sarah's skepticism just evaporates entirely.
It's gone.
It's gone. She immediately recognizes the firm, and she refers to them as the corporate defense sharks. And she admits that Marcus now has her full, undivided attention. So we move immediately from standard regulatory compliance to something vastly more aggressive here.
Yeah, and what's fascinating here is the specific market reputation that Sarah is reacting to. Wachtell is not the firm you hire to simply dot your I's and cross your T's on a standard public offering.
Right, you don't call them to fill out paperwork.
No. And in the realm of corporate law, they are synonymous with complex structural warfare.
Warfare. Wow.
Truly. They are historically known for architecting defenses against hostile takeovers, designing intricate poison pill provisions, and structuring highly unconventional corporate governance models. I mean, Sarah explicitly states in the text, You don't call Wachtell unless you're expecting a fight or doing something incredibly complicated.
And that raises a critical point, I think, about the mechanics of this potential IPO.
Yeah.
I mean, put yourself in their shoes for a second. Why would a company generating this much market enthusiasm need to anticipate a fight?
Right.
If you are the dominant player in arguably the most transformative technology sector of the decade, shouldn't the path to the public markets be, a relatively smooth red carpet?
You would think so, but that assumes the traditional IPO process is a celebratory event, when in reality, it is a massive vulnerability.
Vulnerability. How so?
Well, let's look at the mechanics of the traditional IPO road that Wall Street usually demands. Typically, the investment banks, the underwriters, they hold the leverage. Yep. They dictate the pricing of the stock, often underpricing it slightly to ensure a quote-unquote pop on the first day of trading. And that benefits their most lucrative institutional clients, not necessarily the company.
Oh, right.
Furthermore, institutional investors traditionally demand standardized governance. They want one share to equal one vote. They want total transparency. They want the power to replace the board or the CEO if performance lags.
So the traditional process is essentially a company conforming to Wall Street's established rulebook in exchange for access to public capital.
Exactly. You play by their rules to get their money.
So when Marcus says, exactly, you hire Wachtell when you want to tell Wall Street we are doing this our way,
yeah,
he is pointing to a massive disruption of that standard dynamic.
Huge disruption.
OpenAI is signaling that they are not going to bend the knee to the underwriters or the institutional demands. They are bringing in a firm known for structural defense to legally fortify whatever unconventional terms they plan to dictate.
Yes, and this could manifest in several ways, which perfectly aligns with Sarah's comment about doing something incredibly complicated.
What kind of complicated things are we talking about here?
Well, the text doesn't specify the exact mechanisms. A firm with Wachtell's pedigree is typically brought in to secure things like aggressive dual-class or even multi-class voting structures.
Okay, so keeping the power in-house.
Precisely. This ensures the founders and current leadership retain absolute voting control, completely regardless of how much equity is sold to the public. Or, considering OpenAI's unique capped profit hybrid structure, which is already weird.
Oh, right, the nonprofit board controlling the capped profit arm.
Right. They might be attempting to take an entirely unprecedented corporate model into the public markets. And Wall Street inherently resists non-standard structures because they introduce unpredictable variables. Wachtell is the deterrent against that resistance.
Okay, let's unpack this for a second. To mandate those kinds of terms to the most powerful financial institutions in the world requires an astonishing amount of leverage. You can't just walk into a boardroom, demand to bypass the standard rules of governance, and expect Wall Street to agree simply because you have expensive lawyers sitting next to you.
No, the lawyers are just the mechanism.
Right. You need the underlying financials to back up that posture. And the source text provides the exact metric driving this confidence.
And this is where the conversation takes a huge turn. The financial ammunition is the core of this entire strategy. Marcus introduces a figure that completely recontextualizes the conversation. He points to rumors of $25 billion in annualized revenue.
$25 billion.
$25 billion.
Okay, here's where it gets really interesting. Marcus labels that number insane. And looking at the broader landscape of consumer tech, or even enterprise SaaS, reaching that velocity of revenue in such a compressed time frame, it practically defies almost every historical precedent.
It does. But we need to dissect the terminology being used here, specifically the term annualized revenue.
Yeah, clarify that for us, because that can be confusing.
It is a crucial distinction in financial analysis. Annualized revenue, or a run rate, does not mean the company has $25 billion sitting in a vault from the past 12 months of operations.
Right.
It is a forward-looking projection. It means taking the revenue from a recent, highly successful period, say the most recent month or the most recent quarter, and multiplying it to project a full 12 months of performance.
Assuming that growth trajectory remains constant or linear.
Exactly. Assuming everything stays exactly as hot as it is right now.
So what does this all mean for their leverage? If that $25 billion figure is a projection based on current momentum, why does it give them so much power over Wall Street right now? In fact, if they are generating that much cash flow, why even initiate a public offering at all?
That's the logical next question.
Why not just remain private, continue compounding that revenue, and avoid the public scrutiny and the regulatory burdens entirely?
Well, this raises an important question about the limits of private markets. Even with astronomical revenue, private markets have liquidity ceilings. Early investors, institutional backers, employees holding equity, they eventually require a liquidity event to realize their
You
returns.
want to cash out eventually.
Exactly. An IPO provides that exit liquidity at a scale that private funding rounds simply cannot match indefinitely. However, the $25 billion annualized figure fundamentally changes the power dynamic of that liquidity event.
How so?
Think about it like this. If a company desperately needs an IPO to fund its next 2 years of operations, the underwriters dictate the terms. They hold the power.
Because the company is begging for cash.
Right. But if a company is already exhibiting a multi-billion-dollar run rate, they don't strictly need the public capital to survive today. They are essentially offering Wall Street the privilege of participating in their future growth.
The leverage completely inverts.
Completely.
It is Wall Street knocking on the door, anxious to get an allocation of what promises to be a historic offering, rather than the company pleading for capital. And that financial leverage is exactly what pays for the legal leverage we talked about.
Yes.
As Marcus observes in the text, this revenue profile gives them the ultimate power to dictate terms. And that includes the freedom to execute whatever complicated, highly fortified structural demands Wachtell is currently drafting up for them.
The two elements are just deeply intertwined. The unprecedented revenue projection acts as a shield, while the elite legal retainers act as the spear.
I love that analogy. Shield and spear.
It fits perfectly, and Sarah, who, remember, she began the conversation by dismissing the legal hires as routine. She completely reverses her stance once the revenue figure is introduced.
Yeah, she changes her tune fast.
She calls the combination mind-boggling, if true. She recognizes that OpenAI is not just preparing to enter the public market. They're preparing to conquer it on their own terms, surrounded by a nearly impenetrable legal and financial perimeter.
Okay, so up to this point in the source text, the narrative is one of absolute, uncontested dominance. They have the forward-looking financials, they have the legal architects of corporate defense, and they are preparing to strong-arm the traditional IPO process. But the text doesn't end there.
No, it introduces a major wrinkle.
Right. Just as Marcus establishes this picture of ultimate leverage, Sarah introduces a highly disruptive variable that forces us to view this entire strategy through a completely different lens.
She pivots the conversation entirely away from Wall Street and focuses on the underlying industry dynamics. And her specific phrasing is vital here. She says, "Don't forget Anthropic. They're right there in the rearview mirror."
Anthropic. That single sentence completely recontextualizes the pacing of everything we have discussed today. We just analyzed how OpenAI has enough leverage to do whatever they want, whenever they want. Yet Sarah's observation suggests that their timeline is not a leisurely stroll.
It's a sprint.
An active sprint.
Yeah, and if we connect this to the bigger picture of the artificial intelligence sector, we really see the fragility inherent in being the frontrunner. A $25 billion annualized run rate is a formidable metric, absolutely. But as we discussed, it is a projection based on current market conditions.
Which can change overnight.
Overnight. In the AI space, the technological moat is astonishingly shallow. Models are constantly being leapfrogged. Compute efficiency is advancing rapidly. If Anthropic, or honestly any other major competitor, releases a model that significantly alters enterprise or consumer adoption rates, that projected run rate could degrade so rapidly.
So the narrative of dominance is really only as secure as the latest benchmark tests.
That's the reality of the industry right now.
And this is exactly why Sarah's final piece of analysis is so compelling. She states, this IPO feels like OpenAI trying to secure the bag before the competition gets too close. Let's look at that phrase, secure the bag. It implies a fleeting window.
It does.
It suggests that the current valuation, which is built on the excitement of that $25 billion run rate, is a peak that needs to be locked in immediately rather than some enduring plateau they can just rest on.
The psychology of market timing is the unspoken undercurrent of this entire excerpt. Let's weigh the contradiction Marcus and Sarah have outlined for us.
Yeah.
Externally, OpenAI is projecting unshakable confidence.
Oh, extreme confidence.
Right. They are hiring aggressive legal counsel to dictate complex terms to institutional investors, leveraging massive revenue rumors to maintain a posture of total independence. But internally, according to Sarah's read of the situation, at least the driving force is acute competitive paranoia.
They are building a massive, legally fortified structure, but they are pouring the concrete as fast as humanly possible because they hear the competition right behind them.
Yes.
Because if Anthropic closes the capability gap, the entire narrative shifts. And in public markets, narrative dictates multiples. If Wall Street starts viewing the AI race as a dead heat rather than a one-horse runaway, the leverage OpenAI currently holds begins to evaporate.
Quickly.
The underwriters might suddenly demand more standard governance. The institutional investors might push back on the valuation.
Which brings total clarity to the aggressive legal posture we were talking about earlier. A firm like Wachtell isn't just protecting the company from the underwriters. They are protecting the company's structural advantages from future market volatility.
Right.
An IPO does more than generate liquidity. It cements a company's status as the default market leader. It secures a war chest of public capital that can be deployed to aggressively acquire talent, secure compute resources, and essentially outspend rivals. By forcing this IPO through right now, on their own highly defended terms, they're attempting to make the gap between themselves and Anthropic insurmountable.
It really changes how we interpret the actions of major tech entities. When a company is this large and generates this much revenue, the assumption is usually that their position is unassailable. We tend to view their strategic moves as the natural, competent progression of a monopoly. But this conversation between Marcus and Sarah strips away that assumption completely.
It does.
It reveals that the most aggressive posturing often stems from the deepest anxieties about maintaining the lead.
It serves as a stark reminder that leverage in the technology sector is transient. You can possess historic revenue run rates and hire the most sophisticated legal minds available. But if the underlying technology is subject to rapid obsolescence, your leverage is temporary. The urgency to execute this complex financial maneuver reveals a profound awareness of their own vulnerability to the sheer speed of innovation.
The insights from this brief exchange are just remarkable when you lay them all out like this. We are literally observing the architecture of a high-stakes corporate strategy in real time. OpenAI is utilizing the immense leverage of a projected $25 billion run rate to fund an aggressive, highly unconventional legal strategy.
Yes, bypassing the standard rules.
Right, aiming to bypass the traditional concessions required by Wall Street, dictating the terms of their public offering to protect their unique governance structure. Yet beneath this armor of financial and legal dominance lies a pressing urgency to secure their valuation before competitors like Anthropic can alter the narrative and diminish their leverage.
It is a really delicate balance of projecting invincibility while racing against the clock. The text beautifully captures the duality of the current AI landscape. Unprecedented financial power coupled with unprecedented competitive instability.
It leaves us with a lot to consider as we watch these filings actually materialize in the coming months. But before we conclude today, we want to leave you, the listener, with a final thought to mull over. We have explored the mechanics of leverage, the role of structural legal defense, and the paranoia of the frontrunner. But consider the broader implications for the sector itself.
It's a big question.
If a technology juggernaut, armed with an alleged $25 billion revenue run rate and the most formidable corporate defense counsel money can buy, is still anxiously looking in the rearview mirror to secure its position, what does that indicate about the extreme volatility of the AI industry as a whole? In an ecosystem advancing at this velocity, is any company's market dominance ever truly secure?
A vital question for anyone observing this space right now.
Absolutely. Well, we deeply appreciate you joining us to unpack these mechanics today. Keep analyzing the structures behind the headlines, stay curious about the shifting dynamics of leverage, and we will catch you on the next deep dive.